Hi everyone. Today I'm here with Michael Houghton, who is with Real Estate Mortgage Advisors, and he has years of experience in the financing world. Michael, thank you so much for being with us today.
Yeah, thanks for having me, Judith. Always a pleasure to help out your clients.
Yes, and you know that the market has been changing, and we have Michael here today because, Michael, I have a lot of questions from my clients, and he has offered to answer them. So, why don't we start with number one? And number one is, what is forecasted for 2023 in terms of mortgage financing and rates?
Got it. Always the number one question. What are the rates? What are they doing? And where are they going? And when are we going to get back to low rates? So let me start off by saying that I think we've hit the cap of high interest rates. So the good news is, in the last 4 months, we've actually had declining rates, and we see that continuing down, hopefully for the next 18 to 24 months. So the good news is rates are declining. They aren't going to go any higher as we see it based on all the economic indicators and forecasts. And there's a lot of creative programs and things you can do out there to even take advantage of lower rates that you may not be familiar with. So we can jump into some of those programs. I can jump into what people are doing. But the overall forecast for 23, probably 24, the next 18 to 24 months, is we should stay rates somewhere in the 5 to 6 range, and hopefully they'll keep declining.
Fantastic. That is good news. Now, why don't you tell us a little bit about those programs, especially for jumbo?
Yep. Because jumbo is so prevalent in our market, everything seems to be at a large number. The jumbo, or what we call portfolio, if you haven't heard those two terms, those are usually loans above 900,000. 900,000 up to 5 million is usually the normal in real estate financing. We have super jumbos that go above 5 million, as high as 20, 30 million, but the core kind of median market here in the Bay Area in California is really about the $1 to $2 million range, somewhere in between. Yeah. 1.5, 1.6 being the average. So those are considered jumbo portfolio. The best things to know about jumbo and portfolio is, one, you want to have a FICO mid score of over 720. You usually want to have at least 10% down. More than likely, a lot of lenders like to see 20% down or more, but jumbo, you can get away with 10%. And then obviously you have to have income to support being able to make those payments. Right. So those are the three items that jumbo are going to contain. The programs that most people are using right now, because interest rates are higher than what we saw on COVID and pre-pandemic, yep, is what we call an ARM, or an adjustable rate mortgage, if you haven't heard of those. And those are 30-year mortgages, but they have a fixed period, either 3 years, 5 years, 7 years, or 10 years. Right. And those interest rates are lower than a fixed 30-year for that fixed period of time. So what it means is you can buffer a loan. If you know what your 5-year plan is, you could do a 7-year fixed loan. If you know what your 3-year plan is, you could do a 5-year fixed loan. It allows you to take advantage of a lower rate and a lower starting rate and a lower payment versus a standard high interest rate at 30-year fixed right now. Right. So a large majority of our clients are using that, and those interest rates by a half a point on $1 million can save somebody as much as $300, $400, $500 a month, depending on where they fall on the spectrum of the interest rate.
Fantastic, great. And I remember the other day we were talking about the buy down rate programs. So can you explain the concept of buy down rate?
Absolutely. So another thing people are taking advantage of is what we call buying down the rate, or prepaid interest, a bona fide discount point. A lot of different terminologies. Unfortunately, in our business, we have a lot of acronyms, yeah, a lot of different names, but they all mean the same thing if you talk to a financing professional. But what they're doing is they're paying sometimes as high as 3% of the loan amount in prepaid interest to the bank, and that will take down the rate from, let's give an example. Let's say your starting rate was 5.25 on a 5-year ARM. If you paid 3 percentage points, or $30,000, you could get that rate sometimes as low as a high 3.875. So now you're in those low rates again. And oh, by the way, mortgage interest rate, if it's paid directly to the bank, is tax deducible, just like any mortgage interest payment that you make already, up to $750,000.
That's fantastic.
Do you want to get into the nuts and bolts of how to do that, or do you want to?
Sure,
Yeah.
very quickly, if you could.
So the way that it works is when you get qualified, a lender is going to tell you, here's what your rate is based on your income, how much money you're putting down, and your FICO score. So that interest rate is going to be calculated for that circumstance, for that day and that transaction, and that will be your starting rate. Okay? Once you have that starting rate, you can ask your lender, can I buy down that rate? And if I buy down that rate, what are my buy down amounts and what does it buy down to? It's not usually incremental to whereas if I pay 1 point buy down, it drops 1%.
Right.
Usually it's in quarters, eighths, halves, things in that regard. It's not a one-to-one correlation, so you definitely want to speak to your finance expert and find out what your base rate is and then see how low you can buy down the rate. Usually lenders allow up to 3% buy down of the actual loan amount, but each lender varies independently, so you'll have to ask those questions.
Right.
But it allows the individual to lower their payments by sometimes as much as 4 or 5, whatever the delta is from that interest rate buy down, and you can calculate how many months you need to be at that lower payment to cover the cost of the prepaid interest.
Correct.
So it's a simple math calculation, but what we're forecasting and what we're hoping is that if somebody buys down a rate, they've got a 5 or a 7-year fixed period and rates drop again, one, they take advantage of the prepaid interest, but they can also then refinance back out and take advantage of the lower rates.
Perfect.
So again, it's all simple math. You just need to make sure you have a conversation with your financing expert so they can walk you through that step and show you the advantage of the discount in the monthly payment.
Yeah, but what you just explained helps so much because, we hear these terms out there, but we don't know how they work.
Yep.
So at least you gave us an overview of how the process works. So then we talk to the lender to get exactly the number.
Right. So those rates exist. We've done some purchase 21-day deals and gotten them as low as 3.75, 3.875.
Nice.
People are blown away as how we do it. It's not free. It costs money, but it does benefit you. It does benefit the bank in prepaid interest, and it might now fit into the program that fits your goals and budgets and what your monthly payments would look like.
That's fantastic. So let's switch a little bit and let's go to another question from my clients, which is, in this case, a seller. The seller has all their down payment money for a new home, and it's tied up to the equity of their current home.
Their existing one, yep.
Exactly.
Got it.
So what are the programs or what do they do in
Yep.
order to buy a new home, sell their current? What happens first? Why don't you talk about that?
Okay, couple different programs. I'll throw you just some quick names that you'll probably hear or have heard of. There's things that are called bridge loans, which means you can take the equity, sometimes as high as 55% of your current equity, take that out to buy a new acquisition, first home, second home, investment property, anything you want to do. Again, those are simple calculations once you find out how much your current home is worth, what you currently owe, and then what your strategy is on buying that new second property or new primary if you're downsizing, or maybe you just want to relocate. I mean, there's a bunch of different reasons. The bridge loan is a short-term loan, usually lasts with 6 to 12 months because the expectation is you're going to sell one home. As soon as that home's paid off, you're going to pay off the other loan. So that's a bridge loan. Usually they collect points up front. It's a high interest rate, but it's a short term, usually 6 to 12 months. The second way people do it is what's called a cross-collateral loan. In that circumstance, there's several vendors out there that actually allow you to take the value of one home, add it to the value of the second home, and lend up to a percentage of the combined value, sometimes as high as 75%, and then you can sometimes finance 100% financing with no money down if you have enough equity in your current existing home.
Nice.
There's still some qualification processes. You still need some income processes. Those are items we can do simple reviews and let you know what you're eligible up to. But again, it's simple math once we go through the valuations and understand kind of your portfolio and what your goals and what you're trying to do. The third one you can do, excuse me, you can always do equity lines. People have heard of equity lines. Equity lines are getting a little tighter now on the amounts that they'll go up to because of the uncertainty on valuations on what's happening with the market. But most lenders will still allow a $500,000 equity line up to about 75%, 80% of their current home market value. So if you have a project or a home or an ADU unit or a investment property, a second home that falls under that 500K window, that's an interest-only loan that you can carry that has a 10-year interest-only period and a 20-year repay after the 10-year. So bunch of different options to leverage that equity.
Right.
Bunch of different options to not actually liquefy, but leverage your assets if you've got a big portfolio.
Right.
There's a lot of people that have made a lot of money in valuation in the last 5 to 7 years, and they want to do something with it. So make sure you reach out to your agent, talk with them about the programs that are available, and then find somebody that knows financing that's done those projects before.
Exactly.
Super popular loans, super cost effective. They're also very popular because you don't have to liquidate your 401k or your stock. If the
Right.
market's booming right now, you don't have to cash out and pay capital gains.
Yes.
I have people call me all the time. They're saying, "Oh, I'm going to sell my stock." Well, have you thought about what you're going to pay in capital gains when you sell that stock? Have you thought about if you take out $1 million, maybe it's only worth 500K? So again, there's a lot of things you want to think about, but it's usually a 5 or 10-minute conversation. We can answer all those questions for you.
And bottom line is there are options. If you're a buyer, there are programs that will get you to the house that you want to buy. If you're a seller and you want to either upsize or downsize, there's also options to help you with that transition. What's more important, as Mike said, is to talk to your real estate professional and your financial professional. So, Mike, thank you so much for being here with us today. You're a wealth of knowledge, so I really
Well, the
appreciate
good news
it.
is we're part of your Keller Williams offering, so we have offices set up in Keller Williams up and down the state of California. So anywhere you're located up and down the state, we can help out, and we've got a physical market center to help you out with an executive finance manager like myself or one of my team members, and we partner and we work for you. So bring it. Have people call. We're here to help out.
Thank you so much.
Yep.
And you know now that we are here to help you, so please reach out. Any questions, and we'll definitely answer. So thank you so much.
Thank you.